And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts. Presented by RIA Advisors.
And good morning and welcome to the show. Of course, it is Thursday, the second best day of the week. Also means that Michael Leibowitz is joining us. Well, every Thursday has a down part, but just joking. Mike and I will talk a little bit about the announcement, kind of the FOMC minutes yesterday, some kind of clues as to what might be happening next with Fed policy. But interestingly enough, Scott Bessent, who is the U.S. Treasury Secretary, was on talking about how Trump's policies are actually disinflationary for the economy. He's right, with the exception of the fact that if there's a rumor going around that the DOGE department wants to send checks back to U.S. households, a refund, so to speak, of overcollected tax dollars. Look, send me some of my tax dollars back. That'd be great. But the problem is that's an inflationary push in the economy, so you don't want to do that. A better way to handle that would just be give everybody an automatic tax credit for this year. So when they file their taxes, they get an additional tax credit, which means that if you don't pay taxes, which is about the bottom 50% of the economy, you'll get a larger refund. So that would be okay, right? So that would be a better way to handle that, but we'll see what happens, what actually comes to fruition. But outside of that, as we've talked about here recently, and Scott Bessent really kind of reiterating this morning, most of the policies that Trump is doing is actually disinflationary, and we saw that during his first term in office as well. Stronger employment growth, stronger economic growth, less inflation. So that's kind of the big headline this morning. Now, a couple of other kind of stock-specific things. Walmart out this morning, interestingly enough. Now, we've talked about the consumer and that potentially the consumer is weakening here a bit. And in fact, in today's daily market commentary, which is on the website now, if you're subscribed, it'll be in your inbox precisely at 7:30 this morning. It's like clockwork, just right there to get you started for the actual trading day. But we actually talk about the consumer weakness and the fact that wages are also signaling weaker inflation in the economy, and that's because you're getting weaker economic growth. Well, Walmart out this morning lowering their estimates for sales to around $250 to $260 a share versus $270 estimates. So that's a fairly decent reduction in forward guidance by Walmart this morning and suggests that the consumer is indeed slowing down. Walmart's been a huge winner, and we're fair disclosure, we're long Walmart in our portfolio. It's been a huge winner in the markets along with Costco. But again, if the consumer weakens, they are going to get impacted. Costco too. So, again, these stocks have had huge runs as of late, big winners over the last year, but again, getting a little bit ahead of where the consumer probably actually is. Another stock that we're long in our portfolio, fair disclosure, Palantir yesterday made an interesting announcement, was down about 10% yesterday. Now, look, that stock has had a huge surge post their earnings. And again, just they had blowout earnings. The stock had a huge run. But yesterday, the CEO came out basically adjusting his share sales that in his filing with the SEC to allow him to sell more shares of the stock. He wants to sell about $1.4 billion worth of stock. I would too if I was him, by the way. but again, that was kind of part of the impact of the stock was just that announcement. But then at the same time, Peter Hegseth, who is the new defense secretary, is really pushing the Defense Department to cut spending. Now, that immediately kind of translated across that was going to impact Palantir in particular. but probably isn't going to be the case. You could do a lot of cuts to government defense spending just by cleaning up kind of the fraud, waste, and abuse that does occur. I mean, there's they've failed audits 7 years in a row. They just, there's a lot to clean up, and you can certainly cut that budget, and don't necessarily cut spending to AI-driven institutions that really kind of where the Defense Department is headed in the future. AI, artificial intelligence, drones, those type of things. So those companies that specialize in those areas will probably be just fine. But again, Palantir has had a huge run. It was extremely overbought. So the pullback on the news was not surprising. Actually kind of give you probably an opportunity to add it to your portfolio somewhere around $100 a share might be a kind of a good entry point. But having said that, that's kind of the two big headlines this morning. So real quick, here's what you need to know before the bell this morning. We're going to take a trip around markets real quick because there's some real interesting kind of dichotomies between what's happening in markets and narratives. One of those, of course, is just simply that, yesterday that the market continues to do well. We broke out clearly to new highs over the last 2 days. That's great. Markets are going to be down this morning. We're going to be down about 16 points on the S&P this morning. Not surprising. Getting pretty overbought here in a short term. Not extremely, but decently overbought enough. We've had a really nice run here, particularly over the last couple of weeks. So again, a bit of a correction here, a little bit of consolidation would not be surprising at all. But interestingly enough, while the S&P is breaking out to all-time highs, the NASDAQ is just challenging all-time highs. So again, haven't really made that breakout. Again, money flows are fine. NASDAQ's a bit overbought here. NASDAQ will also be down this morning in sympathy with the S&P. Again, it's not anything really driving the markets this morning, really just kind of exhausted. A little bit of a pullback was needed here. But again, the NASDAQ has not broken out to all-time highs as of yet, like the S&P. If we take a look at the equal weight index, it also, of course, has been lagging the S&P itself. So again, we're kind of back into that same dichotomy we had last year, where the market cap weighted sectors of the markets really kind of driving the overall markets. The equal weighted index, which has less of the Mag 7 in it, really kind of dragging relative to the overall markets. Had a nice rally back in early 2020, early this year. When there was a lot of pressure on those Mag 7 stocks, we saw a pickup in some of those non-Mag 7 stocks. But again, since then, has not really done much of anything. And again, that performance gap is now about 10% between those two indexes. Same thing for the IWM, Russell 2000. This is also going to feed over just small caps, mid caps in general. Really have not done a lot. Big gap in performance now between the Russell 2000 and large cap stocks. And again, kind of the same thing in small cap itself. And you can hardly tell the difference between these indexes. But again, there's not been a lot of performance pickup in small and mid cap stocks relative to large cap stocks. So much like we saw last year, it's been a flow of money into kind of really the passive index funds, which now make up about 60% of the overall market between active and passive funds. Passive funds make up about 60% of that market. That's really just fueling those passive indexes, market cap weighted generally, just kind of funding those top 10 stocks, and that's creating this performance gap that we're seeing within markets. Been a lot of talk here over the last couple of weeks about international stocks have had a huge surge since the beginning of the year, and it's true, you can see this kind of big run. But again, while markets like the S&P and NASDAQ close to breaking out or have broken out to all-time highs, international stocks still way off their previous highs, just going back to October of last year. So yes, they've had a nice recovery, but all you're doing is really recovering a lot of that sell-off that you had right at the end of last year. So again, we see this kind of at the beginning of every year. It's this kind of chase to get into these, it's like, this is the year. This is the year that international is going to do great. This is the year that small cap is going to do great. You got to buy small cap. You got to buy international. This is the year. And every year, it just hasn't come out to be the case. Maybe this will be the year. I'm not saying it can't be. It just hasn't been for like the last 14 years. So, we just kind of continue to see this languishing performance. Same thing on emerging markets. Yes, they've had a very nice rally since the beginning of the year, but again, nowhere even near close to getting back to where they were back in October. So again, just, be careful. The point is that, be careful with narratives, and look, there's opportunities. This has been good trades in international and emerging markets here since the beginning of the year. It's been a really good little trade here. The question is sustainability. Do the fundamentals, do the economics, do those type of things continue to support outperformance of those markets relative to where capital is flowing in the short term, which is, and really in the intermediate term, which has been kind of these large cap indexes. Is this year it changes? Maybe. But again, as of now, we're not seeing that performance shift just yet. That's what you need to know before the bell this morning. We come back and pick up with Michael Liebowitz, talk all about the Fed minutes yesterday. What was said? Does it make any changes? What does this mean for the markets? And what about QT? That's all coming up next on The Real Investment Show.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
The Social Security Fairness Act dropped elements that reduced Social Security payments, retroactive to last year.
What are you going to do with all that extra income?
Our next Candid Coffee offers savvy Social Security planning if you were dinged by windfall and pension offsets.
Saturday, March 29th.
Richard Rosso and Danny Ratliff answer your questions about Social Security benefits and what the removal of WEP and GPO means for your retirement. Candid Coffee with Ratliff and Rosso. Register today at realinvestmentadvice.com.
Attention Chevron employees and anyone else receiving or considering a company severance package. We know the process can be intimidating. What should you know to maximize your payout? Lump sum or pension annuity, retirement plan rollover or not? What about tax timing your severance? The fiduciary advisors at RIA Advisors can help you make the best decisions for your situation. Call us today at 855-742-7526. That's 855-742-PLAN. Or online at realinvestmentadvice.com.
The Real Investment Show.
RIA Advisors Research is the envy of the industry. Our economic insights are featured on advisorperspectives.com, Fox Business, and MarketWatch. RIA provides advisors with marketing and back office support, objective research, and holistic, cutting-edge financial planning tools to meet your clients' needs. Want to join a winning team and be part of a fiduciary culture where you can do your best work? Then why haven't you contacted us yet? Go to our confidential advisor hub at realinvestmentadvice.com. RIA Advisors. Big enough where it matters, agile enough when it counts.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
Just real quick before I get to Mike, interesting headline just came across Bloomberg News a second ago. And again, actually what I'm writing about for this weekend's newsletter, I touched on the surge in margin debt on Tuesday and talking about this kind of return of retail investor exuberance and how investors are just piling into leverage. And what's interesting is there's always the old saying is that this time isn't different. The difference this time is that retail investors are using leverage to buy more leverage. In other words, they're buying leveraged ETFs on margin. So they're really ramping up that leverage. Well, as is always the case, when there's a lot of investor appetite, Wall Street is more than happy to supply products to investors to meet that demand. So if there's a lot of demand for something, then Wall Street's going to provide the product. And Wall Street doesn't care if it works or not, right? They just want you to have the product so you can put your money in it and they can make their money. There has been a huge surge in money going into the veterans of the SPAC industry. In other words, over the last 12 months, as this market's kind of been ramping up, and now just this year already, they've already raised about 20% more of their total funding. But there are billions and billions of dollars going into these companies that can issue now SPACs. And if you don't remember what a SPAC is a special purpose acquisition company. And it's essentially a public company that has no investment. People put money into it, and then they try to go out and find an investment to put the money into, to roll it into that SPAC, to make the acquisition. So, the last time we saw this, of course, was 2021 in the height of, checks to households and stimulus and QE and all this other stuff. We saw this kind of madness in the markets. SPACs were there. Of course, those all blew up spectacularly in 2022. But again, it's just interesting that at the same time we're seeing this massive surge in margin debt, we're now seeing the Wall Street veterans of the SPAC industry now wanting to bring SPACs back into the market. So I just thought that was just kind of another interesting point about how exuberant this market's currently getting. But speaking of exuberant, everybody just still holds on to the onto the Fed, every little word. And yesterday we had the FOMC minutes out. Now the minutes are posted after the meeting, and these are not the actual minutes. So if you were actually sitting in the room, I am sure that there was a lot of stuff said in that room that never made it to the minutes. But these are well crafted minutes from the meeting of really kind of the messaging that the Fed wants out there. And there was a couple of interesting takeaways. And Mike, what was your initial thoughts about that yesterday?
Real quick though, I'm going to double back to your exuberance because the topic for tomorrow's daily commentary is the latest ETF that Tuttle Corp is putting out. Have you heard about this one?
I have not heard about this. What is it?
Alien technology. UFO alien not foreign country. The real alien technology.
Wait. So, but an ETF is a vehicle that invests in other. What's he investing in?
They will invest, according to the article, in at least 80% of supposed technologies that are assumingly defense and aerospace companies have gleaned from aliens. Now they.
This is genius. This is absolute genius. Are they gonna put some leverage on this? Because that would be even better if there's like a 2-for-1 on aliens.
This is like a meme coin. There's nothing behind it. But yeah, you'll read it tomorrow, and it's still a proposed ETF. It hasn't been approved by the SEC. The company knows that if it turns out there is no alien technology, there's no ETF. But again, exuberance is running sky high, actually beyond sky high now.
Yeah, no, it's actually just very interesting. I mean, and again, this is very reminiscent to what we saw in 2021, where, people were coming to the markets with all kinds of stuff, whether it was meme coins or whether it was, SPACs or IPOs or a variety of different things. It was just, again, this is what happens when you have too much money chasing too few assets. We've talked about on the show before, Mike, is that in 2000, there were 8,000 publicly traded, companies on the markets, not including pink sheets, but just, full traded 8,000 companies. That's down to 4,000 now. So we've reduced the actual number of publicly traded companies out there. So you've got more money chasing fewer companies. And now that just opens up this whole market for just, I need something else to invest in and to bring stuff to market. It's very fascinating.
Right. And no one wants to accept 5, 6, 7% annual returns anymore.
Right.
So yesterday.
Yeah.
Everyone wants to hit the home runs. No one cares about the singles or doubles.
No, that's absolutely right. Well, speaking of singles or doubles, there's Scott Besson out this morning again, as I mentioned, was talking about, Trump's, a lot of Trump's policies are disinflationary. But he's also dealing with the potential debt ceiling limit that's coming up and Treasury funding. And this was kind of one of the things that was noted in the FOMC minutes yesterday by the Fed relating back towards QT.
Yeah, I thought so. The minutes in general were kind of bland, kind of what you thought. The Fed's been on the same page with each other. They're all kind of they're on hold. They're waiting. They want to see more signs that inflation is coming down, not just stable, and potentially weakness in the labor force before they start cutting rates again. The one interesting comment that was made is that several participants suggest halting or slowing balance sheet reduction pending the debt ceiling resolution. So basically what they want to do is stop or suspend QT while the debt ceiling resolution is going on. why, I can't really get my head around why they would want to, first of all, announce it. But there's one logical explanation, and it's clearly something they're not going to tell you. The reverse repo purchase program, RRP, RRP, was issued or started up in 2020. The Fed basically loaded the market with liquidity, and the liquidity would have pushed interest rates well below zero. So the Fed said, we need something else to suck up the excess liquidity. So they created this repo program, and it served its purpose, but it was a bank of excess liquidity. And you could pretty easily tell how much excess liquidity was still in the market from the pandemic and all the stimulus that came with it. And at its high, it hit about 2.5 trillion, and it's been coming down for 2 years, 2.5 years now. It's now back down to virtually zero. So there's no bank, no storage of extra liquidity. So now, as the Fed starts doing QT going forward, they are reducing liquidity, whereas liquidity was sort of being matched by drains, by the RRP draining. So I think the Fed is starting to starting to appreciate that liquidity is potentially a problem, and that problem will only grow with each month that they do QT. So this may be the excuse to get them to stop draining liquidity via QT.
Well, so that was kind of the other side of this is like, oh yeah, we're just going to temporarily, halt QT while we're dealing with the funding issue. But, that's kind of always the initial kind of statement, and then it never gets reinstated, right? They never go back to QT. They just stop doing QT, and they use that as an excuse, but they never actually go back to it. Because again, there is risk of this liquidity draining out of the markets, and that they could be getting more concerned about the risk of that relative to financial stability. So an easy way to kind of get out of QT without really spooking the market is saying, oh, we're just going to temporarily halt it, but then just never restart it again.
Right, but here's the funny part. If the government stops issuing debt, right, there's not going to be a lot of debt. So there's going to be extra liquidity floating around because it's not being allocated to debt. Wouldn't you want to do QT then to kind of soak up some of that liquidity?
Well, you would think so.
Not stop QT. Right. It actually doesn't make any sense now that I think about it.
But so it's going to be interesting. And again, we've talked about before is that the Fed is has always been prone to making mistakes, right? And you go back in history, they just they're either too late, too early, too much, too little. So this could very well turn out to be just another potential mistake here, because again we've talked about the fact that the Fed's talking about, oh well, we're pausing rates now, we're worried about inflation, employment strong, but if you actually start digging down into a lot of the employment data, it's not that strong. Wages are declining, employment is really kind of deteriorating around the edges. Outside of the trail, they're looking at very much lagging data that's coming in. And if you take a look at kind of more real-time data, there is certainly some stress within the markets. And in fact, even home builders were out just yesterday. A couple of headlines out yesterday from home builders saying that they're getting crushed by higher interest rates. And home builders, if you take a look at home builders versus the market, they've been absolutely getting decimated over the last several months. But that's a function of rates, and we've talked about this before, is that rates have an impact on a highly leveraged economy, but it just hasn't caught up yet to the actual data that the Fed's looking at. So again, the big risk is that the Fed's going to be too late again cutting rates when this stuff just starts to manifest itself in the economy. We'll be right back with Michael Liebowitz. Don't go away.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
The Social Security Fairness Act dropped elements that reduced Social Security payments, retroactive to last year.
What are you going to do with all that extra income?
Our next Candid Coffee offers savvy Social Security planning if you were dinged by windfall and pension offsets.
Saturday, March 29th.
Richard Rosso and Danny Ratliff answer your question about Social Security benefits and what the removal of WEP and GPO means for your retirement. Candid Coffee with Ratliff and Rosso. Register today at realinvestmentadvice.com.
Attention Chevron employees and anyone else receiving or considering a company severance package. We know the process can be intimidating. What should you know to maximize your payout? Lump sum or pension annuity, retirement plan rollover or not? What about tax timing your severance? The fiduciary advisors at RIA Advisors can help you make the best decisions for your situation. Call us today at 855-742-7526. That's 855-742-PLAN. Or online at realinvestmentadvice.com.
The Real Investment Show.
Are you a financial advisor sneaking peeks at our stuff? Instead of trying to do it all yourself, why not just join the team at RIA Advisors? Our full-service organization can provide you with the support, unparalleled research, and tools for managing your clients' money and honoring the fiduciary pledge of putting clients' best interest first. Don't take our word for it. Talk to the advisors that work with us. Want to come win with us? Go to our confidential advisor hub at realinvestmentadvice.com. RIA Advisors, big enough where it matters, agile enough when it counts.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
You know, there's been lots of debates over shutting down Department of Education, and that's really failed as a government agency to ensure that our children are getting a good education. Well, I have further proof it's probably a good idea that we try something different.
The Real Investment Show podcast.
I noticed this morning as I was getting ready for work, I looked at the milk carton and it said expiration date, February the 30th.
Same show, your schedule.
Just curious who was putting the expiration dates on the milk.
At realinvestmentadvice.com.
Apparently I have milk that either never expires.
It's the gift that keeps on giving.
Yeah.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
If you're working and looking to retire soon, a Medicare special enrollment period is in your future. Understanding Medicare choices, enrollment deadlines, and costs are essential to your overall standard of living in retirement. The wrong choices can cost you thousands in penalties. Make sense of Medicare's alphabet soup with RIA Advisors' online resources and one-on-one partners to help secure the healthcare insurance choice that is right for your lifestyle and budget and avoid gaps in coverage. Click on the insurance tab at realinvestmentadvice.com today. realinvestmentadvice.com.
The Real Investment Show YouTube channel has all our videos ready for your easy access. Subscribe and bookmark our YouTube channel at realinvestmentadvice.com.
You're listening to The Real Investment Show.
And welcome back to the show this morning. So, while we were on break, I was reading through chat, and they're having an entire conversation about Kentucky Fried Chicken versus Cane's. Now I'm hungry to start with. I didn't eat dinner last night, and so I'm starving this morning. Anyway, so, and yes, KFC, let me just solve the debate for you. KFC is boomer chicken. Cane's is millennial millennial and Gen Z chicken. So, yes, my kids will not eat KFC. They will eat Cane's or Chick-fil-A. So, but let me just solve it for you right now. Yes, if you're eating at KFC, yes, you're a boomer. So, or a Gen Xer. Gen X falls in that category too. So you're Gen X or boomer if you're eating at KFC. That's old chicken. I know, right? Exactly. So not everybody's hungry. Thanks, chat. We appreciate it. And since you made us hungry, be sure and subscribe to the channel and like it. That's your penalty. That's your penalty box. Like the channel. All right. Just talk a little bit about the Fed rate cut. Sorry about the Fed FOMC minutes yesterday. In that, Mike, reading through those minutes yesterday, again, like you said, nothing really surprising out of there. Really kind of stated the Fed's going to be on hold, at least for the time being, which it means that by the time they realize they need to start cutting rates again, it'll probably be too late. But, again, nothing in there. I mean, did you see anything in there that you thought was surprising or interesting that, might suggest something other than the QT issue, I guess?
No, not really. I mean, they're really handcuffing themselves, I feel like. I think they're scared of this latest uptick in yields, and they don't want to see yields go much higher. They don't want to see them go a lot lower. And I think the recent, I'm not going to say uptick, but stabilization of inflation, kind of stickiness of inflation, is concerning a few. Beth Hammack from the Cleveland Fed has kind of raised the specter of raising interest rates to combat inflation. That voice was not echoed throughout the Fed, but it is worth noting that, that I guess is on the table, even though the odds are extremely low. So the Fed is handcuffing themselves. And like you said, retail sales was extremely weak. Walmart, a great barometer for the consumer health, is out this morning with some pretty weaker than expected news. There's some other signs that the economy the Cass Freight Index is at very low levels. So there are signs that the economy is starting to show that it's weakening. Again, it doesn't mean we're in a recession, but there are some signs that could become troublesome if they continue throughout the economy. That bears watching. And I think the Fed would probably be better served if they had just more of a two-way stance, that we're prepared to cut if we want to cut, and if we want to raise, we're going to raise. And I felt like they've gotten away a little bit from that. We'll cut at any time, like they were 2 months ago. And they've, they're basing it on inflation, which lags, just about a month and a half or 2 months, and has some lagging features in it that lag 6 months to a year. So, I think the Fed is once again getting themselves caught in a trap.
Well, they did this to themselves last September, too, when they cut rates by 50 basis points. And you and I had numerous conversations. There was no reason to cut 50 basis points at that time. I mean, the economy was fine. Economics were fine. Markets were doing exceptionally well. No reason to be overly concerned. They should, if they were going to cut rates, do 25 basis points with a wait and see type of approach. Hey, we're going to cut rates 25 basis points. We'll kind of wait and see, kind of how things play out. Then we, leave ourselves open to cut 25 basis points more. But, they were trying to potentially, I don't know if they were trying to influence the election outcome or what it was, but there was really no logical reason to cut 50 basis points back in September. Then they cut again following that, really kind of got themselves into this trap because, again, inflation doesn't just go straight down. It's going to bounce around, and especially when you start getting into tough year-over-year comparisons like we are now, you're going to have this stabilization of inflation just on that comparative basis. And then you have events come along like the bird flu, like the issue with the chickens that's going on right now. We had to slaughter a lot of chickens. That's causing inflation and egg prices. You had oil prices go up. So you have these short-term impacts that also lead to inflation that was going to potentially box the Fed in, and that's what's happened. They've gotten themselves kind of into this trap by trying to cut rates too aggressively on the front end. Again, not really understanding the reason why that they did 50 basis points back in September. That really didn't make a lot of sense. But now they've kind of got themselves in a bind about what to do next, and the probable outcome is, like we were talking about earlier, is they're going to wind up making a mistake here. Something's going to show up economically. Then they're going to be forced to start cutting rates a lot more aggressively than they thought they were going to.
Well, the problem is they can't keep their mouths shut. They love this. They love this forward guidance.
Right.
They don't want to surprise markets at all. And I get it. I understand that, right? They don't want volatility. But in the process, they tell you every little thing they're thinking and every little swerve in the road of monetary policy. And I think that can be very detrimental. Like when they cut by 50, it wasn't just the 50. It's that they said, we're going to most likely cut the next two meetings.
Right.
So they basically cut by 1%, or told you they were cutting by 1%, which makes it hard for them to back out of that. And, I think while they wouldn't prefer it, I'd prefer a Fed that kind of kept quiet, that, maybe we heard now and again from the Fed, but let the market think what it wants. And it can catch back up to the Fed when the Fed tells you what they're thinking. But the Fed needs to be like a quarterback in the NFL. You have options. You can hand it off to the running back. You can throw it. You can throw the ball away. You can do whatever you want. You don't tell the other team what you're doing. And I think the Fed should take much more of a tack like that with monetary policy and just keep your mouth shut.
Well,
and there's what, 5 speakers a day every day?
Yeah, no, and there's more today. But, dude, that's actually right. I mean, back in the 80s and the 90s, nobody knew who the Fed was. I mean, we knew there was a Federal Reserve, right? But you couldn't name one single member of the Federal Reserve. And now everybody knows their names, and the markets are just the markets no longer pay attention to any fundamentals. It's just what's the Fed going to say? How's the market going to react to what the Fed's going to say next? And again, if they were, and again, following the financial crisis, that was when they started issuing out these quarterly updates about their forecast for inflation and economic growth and employment. And they're terrible forecasters, right? Their forecasts are never right. But they put these forecasts out there, then the market starts trying to predict, okay, well, what does this mean for Fed funds rates, based on these forecasts, which are never right. And it just causes a whole lot of problems for the markets eventually, because again, to your point, is that the markets are adapting to every little thing they say, so they get themselves into trouble by doing that, where they can't change policy as needed to really do their job effectively, because they trap themselves in their own narrative.
Right, and the market steers them, I feel like, too, at times.
Yeah.
Like the market will interpret something someone says or something a bunch of them say and moves a certain way, and then the Fed kind of gravitates to that logic, and it's problematic for the Fed, because they should be running policy on what they think at that time, right, what their forecasts are, not on what what the market or Wall Street thinks they should be doing.
Right. No, exactly. Again, it's their job is to run monetary policy, not run markets.
Right. And, again, you have these speakers. Some of these are dovish, some of them are hawkish, and whoever's speaking that day is the voice of the Fed. So if you have 3 dovish speakers today, all of a sudden market kind of gravitates slightly to a dovish tone. Or if you have hawkish speakers, and when we say gravitates, it's actually moving the Fed funds futures markets. It's moving bond markets, which then indirectly move the stock market and commodity markets and other markets. And adjustments, as these happen, you're changing the cost of capital for the economy, and that's not healthy. And I understand that a lot of volatility, because the market doesn't know what the Fed's doing, isn't healthy either. But there shouldn't be volatility around what the Fed is doing with the overnight rate.
Right.
Right. Okay, don't get me going on this diatribe.
Well, no. I mean, but this is kind of the whole issue, and we've talked about this so many times. And it's the Fed controls the short end of the curve, and that's fine. They can certainly work around that end, but now you're starting to impact the long end of the curve because of what you're doing on the short end as well, by the narrative that you're putting out, and this is leading to bond traders and bond markets basically moving yields and bond prices out from where they should be trading on the fundamental basis of the economy. And that's that, we've talked about before, that's that term premium, that's the sentiment, but that sentiment, that term premium is being driven by what the Fed is doing on the short end, which it shouldn't be the case. Quick break, we'll come back, get ready to wrap up the show with Michael Liebowitz. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
The Social Security Fairness Act dropped elements that reduced Social Security payments retroactive to last year.
What are you going to do with all that extra income?
Our next Candid Coffee offers savvy Social Security planning if you were dinged by windfall and pension offsets.
Saturday, March 29th.
Richard Rosso and Danny Ratliff answer your questions about Social Security benefits and what the removal of WEP and GPO means for your retirement. Candid Coffee with Ratliff and Rosso. Register today at realinvestmentadvice.com.
Attention Chevron employees and anyone else receiving or considering a company severance package. We know the process can be intimidating. What should you know to maximize your payout? Lump sum or pension annuity, retirement plan rollover or not? What about tax timing your severance? The fiduciary advisors at RIA Advisors can help you make the best decisions for your situation. Call us today at 855-742-7526. That's 855-742-PLAN. Or online at realinvestmentadvice.com.
The Real Investment Show.
RIA Advisors Research is the envy of the industry. Our economic insights are featured on advisorperspectives.com, Fox Business, and MarketWatch. RIA provides advisors with marketing and back office support, objective research, and holistic, cutting-edge financial planning tools to meet your clients' needs. Want to join a winning team and be part of a fiduciary culture where you can do your best work? Then why haven't you contacted us yet? Go to our confidential advisor hub at realinvestmentadvice.com. RIA Advisors. Big enough where it matters, agile enough when it counts.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
Welcome back to the show. Just getting ready to kind of wrap the show up this morning. Markets right now pointing down just a bit. A few earnings reports out this morning. Walmart reported this morning. A little bit of disappointment there. Palantir, again, like I said this morning, that's going to be down a little bit more this morning as well. I'm going to step out of the conversation. I'm going to let Mike hang himself with his latest article on Bitcoin versus the dollar. So, Mike, here's the news. Go for it.
Okay. So it's not really Bitcoin versus the dollar. It's why Bitcoin can never replace the dollar. And I realize that I am seeking punishment, especially on social media, where, once you say anything that's not positive about Bitcoin or cryptocurrency, you get skewered by the laser eyes. Mm. So here it goes anyway. Hopefully you guys will treat me a little bit better. When we talk about the price of goods, we say oranges cost $1.50 or a car costs $50,000, but what they really are fractions. How many oranges per dollar? How many dollars per car? Right? It's a fraction, and we assume that inflation is coming from the oranges or the car. And that's part of the equation, the supply and demand of cars, for instance. But there's also the supply and demand of dollars. Remember, it's a fraction. So one of the key points I wanted to get across in this article is that the supply of money is important. So money can be anything, first of all. Money is the US dollar. It can be this pen on my desk. It has been salt. It's been gold. It's been tea. It's been all kinds of things. Banks used to print money. Every bank would have their own money. So let's pretend salt is money, right? Mm-hmm. And here's the problem with having anything other than dollars. And I'll get into the Bitcoin problem. Well, we have a bunch of salt and then we have a leak in the house and it dissolves the salt. There's less money in the system, right? So the less money there is, the more it's worth. The more the dollar's worth, the less those other things are. That's deflationary. Conversely, we find a whole dried up ocean bed full of salt. The supply of salt triples overnight. You have rampant depreciation of the salt because there's so much of it now, which means rampant inflation of all the prices of the goods the salt can buy. And this is the Bitcoin problem. There's only going to be 21 million Bitcoin. And with each Bitcoin mined, it gets harder and harder to produce. So you cannot to have a dynamic economy, you also need to have a dynamic currency that is regulated. And I'm not saying regulated by the government. It could be regulated by the free market, but there has to be a correlation, a good correlation between the supply of money and the economy. Because otherwise you're creating, like in Bitcoin, you're creating a situation where there's just not enough Bitcoin, where the demand for the money, the Bitcoin, is high. So that's going to create an appreciating Bitcoin, which is deflationary. And if we're in a deflationary environment and everyone knows it's deflationary, why would you go out and buy a car today or a house today? You can buy it tomorrow or the day after that or the day after that. You're going to delay as many purchases as you can because they just get cheaper. If you're a company, why would you invest in a new employee or a new plant today? Well, why not wait 3 weeks when it's going to be cheaper? Mm-hmm. So economic activity gets postponed because everyone knows it's going to be cheaper in the future, and you're better off holding dollars or Bitcoin or whatever the currency is. Right. So that's a huge, huge flaw with Bitcoin. So then you say, well, there's all these other currencies, cryptocurrencies. That's the opposite problem. Anyone can create a cryptocurrency, a meme coin, all these things. They're very easy to create. So if we just say every cryptocurrency can be currency, then you have way too much money. And that's a huge problem. That's a very inflationary problem. No one's going to want that money because there's so much of it. So the supply problem, and it's not that it's regulated, but it's not regulated and correlated versus the economy. And the debate about whether the government should do that or whether the free market, that's a different debate. But the money needs to be regulated and aligned with the economy. And that's a fact, whether you like it or not. There's also what I call a constitutional problem. Is one of the reasons that Donald Trump, for instance, has all the power that he has right now is because he controls dollars. Dollars are what makes the world's economy spin, makes the world spin, and every economy around the world active. They all trade in dollars. You take away those dollars, Donald Trump can't do a lot of the things that he's trying to do now. And for that, matter, all the other presidents. So the ability to fund ourselves at levels that make sense becomes much more difficult with Bitcoin. And it really could negatively impact the sovereignty of this country and the power that we have. And then I kind of end with just a practical, huge problem with Bitcoin is the volatility. And Lance, we've talked about this a lot. Yeah. Price of Bitcoin is all over the place. So what I did was I just said, let's just say we start I started January 1st, 2025. I said, we have a $500,000 house, and I figured out what the price of Bitcoin was at that time. And I just charted the gains and losses in that price of the house over the period. I had the daily high and the daily low. And there was a week, January 13th to January 20th of this year, where the price of the house would have been as low as $470,000 and as high as $575,000. That's a huge swing in a week. It makes it unable to transact. Buying a house, if you're buying a candy bar from the store, maybe that extra 3 or 5 cents isn't a big deal. But when you think about the transactions that really keep our economy going, the houses, the cars, all the corporate, $100 million, billion-dollar investments, those aren't possible with a currency that is just whipping around for no apparent reason.
Well, and again, I think specifically to the house, like, for instance, if I go to buy a car today, Mike, I mean, I can go to the dealership. If the price of, Bitcoin is $100,000, then, I can buy a car within literally an hour or two, right? So I don't have a lot of variability in the house, in the car. But if I'm trying to sell my house or buy a house, that takes several weeks, right? Because you've got to set the closing date. You got to, get all the paperwork done, go to close on the house, transfer the funds. And if you're a week or two in that process, and I'm the buyer or the seller, and the price is jumping all over the place, how do you close on the transaction? Because you don't know what the price is.
Right, but let's go back to your car example. So let's say, okay, Lance, you got 100,000 in Bitcoin, right? Mm-hmm. And first of all, you're going to start to look at cars. Are you going to hold that in Bitcoin, or are you going to hold it in dollars, and then just convert it to Bitcoin at the last second? Right. So if you're just sitting there waiting, that price of the car is fluctuating up and down. And conversely, if you're the dealer, second you hand me that Bitcoin, I'm converting it to dollars. So in both cases, it makes a lot more sense to convert it to Bitcoin for that split second the transaction occurs, and convert it to dollars for all the other periods surrounding that transaction, which begs the question, why Bitcoin then? If you're going to hold it in dollars until the point of transaction, and the dealer is going to convert it to dollars after the transaction, just transact in Bitcoin, right? So even with a kind of quick purchase like the car, like your example, but again, like your like a house or a company that has to build a nuclear plant, they take 10 years to build. You're constantly spending money throughout 10 years to build that. Can you really trust that Bitcoin is not going to be all over the place and either default could literally default a company trying to build a nuclear reactor using Bitcoin, or it could make it almost free, depending on what happens to the price of Bitcoin. But that's not a chance companies are willing to take.
Right. No, it's interesting. The whole article is on the website now. So if you want to read the whole article, see all the charts go along with it, go to realinvestmentadvice.com. It's there for you. And again, but it's an interesting conversation, right? At the end of the day, right now, right, it's just that, the correlation between the stock market and Bitcoin is one. We talked about this on Tuesday. The correlation between the stock market and gold is one. The market amongst themselves, whether it's international, emerging markets, domestic, those correlations are one. This just goes back to our early conversation today about SPACs, which is that we're creating all these narratives about why this is a good asset or why that's a good asset and why do you want to own this versus that. And the reality, though, is everything is going up because there's too much money chasing too few assets. So these theses really don't mean a whole lot, when the reality is it's just speculation driving markets right now, and it's driving every virtual market we have. So, all right, that gets ready to wrap up the show for the day. I thought Mike was going to give me an out cue there, but I got nothing. I honestly couldn't hear you there. You're breaking up. Okay, well I'll blame Brent for that. So, all right. All right, the wraps up the show for the day. Be sure to get by the website. Michael's article is out on the website now. It was posted yesterday, so it's there for you. Also, our daily market commentary is out on the website now, but it'll be emailed to you if you're subscribed at 7:30 sharp. You'll have that. We'll have this our newsletter out this weekend. Make sure you're subscribed. We'll get that emailed to you as well. You can also get all of our research on our Substack channel at Lance Roberts. So you got multiple ways to get our research. It's all there for you. It's all free, at least for now. Go get it. realinvestmentadvice.com. Have a great day. We'll see you back here tomorrow.